Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question for the topic financial statements. In this question, you will learn to correctly prepare the statement of financial performance and the statement of financial position for a PTE limited company. You can see the question on the left hand side of your screen, and on the right hand side, we have got all the workings which I'll go through and explain to you step by step. Our goal by the end of today's session is to ensure that we can get a perfect score of 20 out of 20 in the main exam for similar questions. With that being said, let's begin. Levin's PTE Limited is a company that provides legal consultancy services. The following balances were extracted on 31 March 2024. So you can see we are given a list of balances for various line items. And we're also given some additional information at the end of the year. So we have 9 transactions relevant to additional information. And the requirement is to prepare the statement of financial performance and the statement of financial position, which is also known as the income statement and the balance sheet. Okay. So let's start with the workings that are required to solve this question. And we'll start by first looking into additional information number 1. Fixtures and fittings are to be depreciated using the straight line method over a useful life of 10 years, and the estimated scrap value is $3,000. How do we calculate the depreciation per annum using the straight line method? If you're given the scrap value, you simply first find the difference between the cost and the scrap value, and then divide it by the useful life, which is expressed in number of years. Now, where can I find the cost value? So the cost price is in the list, and you can see I have included additional information number 1 so that I can correctly identify all the relevant line items that have been involved. So that gives us the fixtures and fittings at cost to be $55,000. Okay, so $55,000 in cost minus the scrap value of $3,000, which is given in the information, and then we divide it by the useful life of 10 years, which gives us a depreciation on an annual basis to be $5,200. Okay. Now, what do we understand by scrap value? Scrap value simply refers to the likely amount that you can sell by disposing this asset at the end of its useful life. So which means after the fixtures and fittings have been used for 10 years, you can get rid of them and you can get a likely amount of $3,000. So that's what it simply means in normal language for scrap value. Okay. Now, what do we do with this $5,200 in depreciation expense? So we know we are interested in preparing the income statement, which is also known as the statement of financial performance. In the income statement, we will include the depreciation of fixtures and fittings as part of our other expense. And when we prepare the balance sheet, which is the statement of financial position, we ought to include the accumulated depreciation, which simply means the total depreciation since the day of purchase. So originally, we are given $15,600 for accumulated depreciation for fixtures and fittings, as you can see here. And then you add the new amount of $5,200, and then that gives us a total amount for accumulated depreciation of $20,800. Okay. Now, let's look into the second additional information. Equipment are to be depreciated at 10% per annum using the reducing balance method. So how do we find the depreciation using the reducing balance method? First of all, we need to calculate the net book value. And the net book value at any given point in time is simply the difference between the original cost and the accumulated depreciation. The original cost is given to us for equipment at $150,000. As you can see, I have included additional information number 2 here. And then the accumulated depreciation for equipment is given to us at $28,500. So we simply find the difference between $150,000 and $28,500, which gives us a net book value of $121,500. Now, using the reducing balance method, depreciation can simply be calculated by multiplying the given rate of 10%, all right, with the net book value of $121,500, which we just calculated, and that gives us a depreciation amount of $12,150. Okay. Now, what's the treatment for this depreciation? Similar to what we have done for additional information number one. Firstly, in the income statement, as part of our other expense, we are to include the depreciation of equipment, $12,150. And then when we prepare the balance sheet, which is the statement of financial position, we show the net amount for accumulated depreciation for equipment, which is $28,500, the initial amount from prior years that we've got, plus an additional $12,150 in depreciation for the current financial year. That gives us a net accumulated depreciation amount of $40,650. All right, so now let's move on to additional information number 3. Interest is charged on the bank loan at the rate of 6% per annum, and the loan was taken up on 1 November 2023. So we understand we are working with the business and we are preparing the financial statements at 31 March 2024. So since the 1st of November 2023 until the end of 31 March 2024, we have got 5 months in total, which are the months of November, December, January, February, and March. Okay. Now, we want to find out the interest expense, which would have been incurred in this 5 months since the loan was taken on 1 November 2023. And how do we calculate this? We simply take the annualized rate of 6% that has been given to us, multiply it with the loan amount of $60,000. Where did we source this information from? Here, when you scan through the list, you will see that we've got bank loan repayable in 2028 of $60,000. And you can see I've included point number 3 here. So that $60,000 multiplied with 6%. And then we are multiplying an additional 5 over 12. Why are we doing that? Because the 6% here is an annualized rate, which means the loan has been only in use for 5 months in the current financial year, and therefore this is being adjusted for the 5 months out of the 12 months that we generally have in a year. Okay, so that gives us an interest expense which we have actually incurred to be $1,500. Okay, and this $1,500 in interest expense incurred is to be included as part of our other expense when we prepare the income statement. Now, if you scan through the list carefully, which I always recommend you do, you would see that at the end, you have been given interest and bank loan of $1,000. So this interest and bank loan of $1,000 here refers to what? Given that we already know the interest expense incurred should be $1,500, right? That means that $1,000 is the actual amount we have paid already, and therefore we are left with $500 left to be unpaid. And that is what we call an interest expense payable. And because it is payable, it means we have an obligation. Therefore, we include this when we prepare the balance sheet as part of our current liability. And that amount we will show is $500. Okay. All right. So just a quick recap. In the income statement as part of our other expense, we include the interest expense, which we have actually incurred for the 5 months since 1 November 2023. And that is $1,500, all right? And when we prepare the statement of financial performance or the balance sheet, we show the amount which is unpaid, that is interest payable of $500, and that is treated as a current liability, referring to a present obligation for the business to pay this off as soon as possible. All right, now let's move to additional information number 4. The rent expense of $15,000 is paid for 15 months up to 30 June 2024. Okay. All right. So monthly rent expense can be easily calculated using this. So how do we do that? So $15,000 divided by 15 months. So that gives us $1,000 per month. Okay. So $1,000 per month as the monthly rent expense. And we know the rent is prepaid until 30 June 2024, which means if our current financial year is ending at 31 March 2024, okay, and we have paid up to June 2024, means we have paid for 3 months extra, which are the months for April, May, and June. So the prepaid rent for this 3 months would be therefore $1,000 per month multiplied by 3, which is $3,000. So $3,000 is what we have paid in excess as prepaid rent and these benefits are to be consumed in the next financial year. Therefore, when you prepare the financial statements at 31 March 2024, you are to include this amount of prepaid rent of $3,000 as the current asset, okay, in the balance sheet. And in the income statement, you will include the actual rent expense incurred for the 12 months ending 31 March 2024, and that is $12,000. And again, if we were to apply accounting theories, it makes sense if you think about the matching theory, which talks about the revenues that we have actually earned being matched against the expenses which we have in fact incurred. So the space that we have utilized for running our office and business, what would actually mean is the rent expense that we include as part of the matching concept is therefore $12,000, okay? And the excess amount, we just keep it separate and show it as a current asset, which is the prepaid rent. Now, what about additional information number 5? Wages and salaries of $2,310 were owing, and office expense of $1,230 was prepaid. Okay. So if that is the case, we understand, first of all, that we have a current liability, and that is what we include in the statement of financial performance or the balance sheet. Sorry, the statement of financial position or the balance sheet. So we show the wages and salaries that are payable of $2,310 as part of our current liability, and the office expense, which we have prepaid of $1,230 is a current asset. Obviously, it's an asset because we have economic benefits that we expect to consume in the next financial year, right? Now, when it comes to the income statement or the statement of financial performance, as part of our other expense, we include the wages and salaries expense that we have incurred for the 12 months until 31 March 2024. And that is the $9,310, which we are given here in the balances, right? And an additional $2,310, which is not paid yet. Therefore, the total amount would come out to be $11,620. So logically, the amount of $9,310 that is included here in the list is the amount which we have already paid, but we also have an excess amount of $2,310, which adds up to the already given amount for expense we have, and the final amount for wages and salaries expense is therefore $11,620 included in our other expense. Okay, what about office expenses, given that we have prepaid $1,230? So if you have got office expenses here, which is $6,200, this $6,200 already includes the $1,230 amount, which is prepaid, okay? So $6,200 is the total amount paid for office expenses. So what we want to do is separate between the amounts for the current year and the next year. So that gives us an amount to be included for office expense of $4,970 as part of our other expense when you prepare the statement of financial performance. All right, now let's move to additional information number 6. Legal fee revenue amounting to $3,200 was received in advance from a client. All right, now legal fee revenue received in advance is a current liability for the business. And why is that so? Because you collected the cash from the customer, but you are yet to deliver on the obligation for which you have collected the cash for, and that is to provide your services, which is what you will provide in the next financial year, okay? So therefore, this is a current liability because we've got a present obligation to fulfill our duties. So what we do when we prepare the statement of financial performance, the statement of financial position or the balance sheet, we include legal fee received in advance as part of a current liability of $3,200, okay? And the income statement, we only show the legal fee revenue that has been earned. So you can see $40,400 is the net amount, which includes the amount that we have also received in advance. But the amount received in advance is not what we can confidently say as our actual income because we haven't delivered on our services, all right? So legal fee revenue earned will therefore be the difference between $40,400 and $3,200, which is the amount that we're excluding for payment received in advance. And that means the actual revenue which we have earned for the year ending 31 March 2024 and to be included in your income statement or statement of financial performance is $37,200. Okay. This is as per the revenue recognition theory, which says that revenue is not necessarily recorded when we receive cash. Anytime like you are receiving cash doesn't mean you can record it as your revenue. You have to make sure that you have delivered on your obligation or fulfilled your services. Okay. All right. Now, what about additional information number 7? It was decided that 2% of the trade receivables were unlikely to be collectible. So the allowance for impairment of trade receivables at the end of 31 March 2024, which is our concern in terms of preparing the financial statements. So allowance is simply derived as 2%, which is the rate multiplied by $32,000 because the statement is very specific that 2% of trade receivables. So where do we source this amount of trade receivables from? From the list, you can see here, $32,000, all right, for trade receivables. So 2% multiplied by 32,000 gives us $640 as the allowance for impairment of trade receivables at 31 March 2024, which is what we will include in the balance sheet or statement of financial position. Okay, now we have got a reversal of impairment loss, or you can also call this a decrease in the allowance for impairment of trade receivables. And when you scan through the list that is given to us, you will see that the allowance for impairment of trade receivables is $780. This is referring to the allowance that we have carried forward from the previous year. And based on our business analysis, we understand that this year it is going to be 640, which means it has gone down from 780 to 640, and therefore the difference is 140. It's a good thing for us given that it has decreased by $140. And the reason it is a good thing is because when we think of allowance for impairment of trade receivables, this refers to the precautionary measures we take, knowing that some of the customers will default and may not likely pay us. So what we do based on historical transactions that we have encountered as part of our business experience, we want to keep some amount set aside so that we are not too overly confident in running our operations. We are rather more cautious. So that is, in fact, also applying the prudence theory, which states that we are not to overstate our assets and profit and not to understate our liabilities and expenses. So we are very careful in that case. Now, when there is a reversal, it is obviously a good thing, but $140 is what we include as part of our other expense. But here is the catch. So when you include it as part of your other expense, we understand all expenses are going to reduce our profit. But now that there is a reversal, when we include this amount of 140, we would show it as a positive amount. And I'll show you this eventually when we go through the statement of financial performance. Okay? All right. Now let's go to additional information number 8. 25,000 shares at $1 each were issued and paid on the 1st of February 2024. This has not yet been recorded. So you may have already prepared for the topic correction of errors, and you would know by now this is what we would classify as an error of omission because we have completely forgotten to record this. So what we are saying in this transaction is that we have raised money. So we have brought in new investors, and these new investors, they gave us $25,000. How do we know it's $25,000? It's clearly mentioning that we have issued 25,000 shares, and each of these shares were sold for $1. So when we issue shares, it is a legal way to raise money from people out there in the marketplace, in this case, our investors, and they gave us $25,000, which is directly deposited into our bank account for running our business, okay? So the share capital that is now actually available is 100 grand or $100,000, which we initially had, as you can see at the beginning of the list, plus an additional $25,000, which we have just raised, and that gives us $125,000 to be included as part of our equity in the statement of financial position or the balance sheet. Now, legally, this amount has to be deposited into a bank account because you're running a private limited company, so which means you're running a PTE limited company, so which means on a large scale you're running your operations, and legally you're required to comply with all the accounting disclosures required in Singapore. So what we do now is we include this amount in our cash at bank. So cash at bank originally is 35,000, but now we added 25,000, add an extra 25,000 to find the net amount of 60,000 for cash at bank, which is again a current asset and to be included in the balance sheet. Okay. What about the last information? A dividend of $0.05 per share was declared on 1 March 2024, but had not been paid. Okay, so this is what we can clearly classify as an obligation, which is the dividend payable, and that is a current liability. So when we have got investors who have given us money or who have invested in our companies so that we can run our businesses and make some profits and also increase the wealth of our investors, the way you can increase the wealth is through giving them their returns, which is the dividends that they expect to earn by investing that money. And in this case, it's specific that we're giving a cash dividend, which is 5 cents per share, and we have 125,000 shares altogether. So initially we had 100,000 shares, then we brought in $25,000 worth of investments. So that increased our share count to 125,000. So the dividend payable will be 0.05 times 125,000, which is $6,250. And that is obviously, as we understand, as an obligation. Now, what we are going to do is, apart from recording this as a current liability, when we prepare the balance sheet, we will also include this within the final amount for retained earnings that we report in equity. And the final amount for retained earnings is simply calculated by starting with the opening retained earnings, which is opening retained earnings at 1 April 2023, being the beginning of the year. That is what you can see here in the second balance, 29,230. Then we add any profit, or if we have got a loss, we subtract it, and then we subtract any dividends which are distributed to shareholders. And the dividends in this case is 6,250. You have not yet really calculated the profit or loss, so we will now have to go through the statement of financial performance first to find the profit and loss. Okay. All right. Now, so let's go through the statement of financial performance for the year ended 31 March 2024, also known as the income statement. So we have prepared this obviously using the usual format. So we start with the legal fee revenue. Now, this is the legal fee revenue that we have actually earned. We had a discussion regarding this when we went through additional information number 6. So it is $37,200, okay? The amount that we have actually earned after separating the amount which we have received in advance. All right. Then legal fee revenue is obviously part of a regular business operations, which is to provide legal services. But apart from that, we can have other income. And in this case, it's commission income. So that is $8,000. Usually when lawyers help their clients win cases, there could be some agreement attached to it where if I can help you win, or if I can help you win this lawsuit, you have to give me this amount, or give me 8% or 10% of whatever you can claim. So as part of our other income, we include the commission income, which is $8,000, okay? We don't have any other income as well. So now we can directly go to other expenses. And the way to do this is to simply just scan through the list, and you'll see that we start with share cap, retained earnings, commission income already taken care of, legal fee revenue taken care of, trade payables and receivables are to be included in the balance sheet because they are assets and liabilities. Same goes for allowance, bank loan, cash at bank, equipment, accumulated depreciation. But the main concerns are therefore these last 4. All right, and then we have got the additional information. So let's start with the first additional information that we used, where we found the depreciation of fixtures and fittings to be 5,200. If you remembered at the beginning of our lesson today, okay? So 5,200, and then you have got depreciation of equipment of 12,150, which is calculated using the reducing balance method. Then additional information number 3, we found interest expense of 1,500, and we had a discussion regarding why this is 1,500. Okay. And then we included the rent expense of $12,000, which is the monthly rent expense of $1,000 multiplied by 12 months, which relates to 31 March 2024, and that is $12,000. Then we found wages and salaries for additional information number 5. So we had 9,300 originally previously incurred plus owing of 2,310. That gives us a net amount of 11,620 for wages and salaries expense incurred. Then we have got office expense of 4,970. Originally, we had 6,200. Then we subtracted the amount prepaid for next year, and that gave us 4,970. And lastly, we talked about the reversal of impairment loss, which we have to include in our other expense amounts. But rather than including it as a positive, we are including it as a negative because it's a good thing for us and it reduces the net other expenses we have as a whole. So therefore, when we add all these balances together, we make sure we get $47,300 as the total for other expenses. This is to be then deducted from the total of the revenue and other income, so which would have been 45,200 when 37,200 is added to 8,000. So 45,200 minus 47,300 in other expenses gives us $2,100 in a loss for the year, because you will see we actually get a negative 2,100, right? And negative 2,100 would therefore refer to a loss. Okay. So let's go back to the closing retained earnings. So the closing retained earnings, as you can see, we have a loss. So that is why we are deducting 2,100 from the opening balance. And then we are deducting the dividends. So that gives us a closing retained earnings of $20,880 at the end of 31 March 2024, which is available for investment in the next financial year starting 1 April 2024. All right. So I believe you're clear with the statement of financial performance. Now let's move to the statement of financial position. And this is to be prepared again using the format that we're required to. So we first start by showing all our assets, mainly the non-current assets. Then we show the current assets. Then we show the total assets. Then we show our equity and liabilities, starting with the equity, followed by the non-current liabilities, lastly by the current liabilities. Okay. So let's start with assets, and we start with the non-current assets. And the way to report the non-current assets is to make sure you show the cost, the accumulated depreciation, and the net book value. So sometimes investors who want to see the financial statements, they want more information. They want to know what is the proportion of depreciation compared to the cost. What's the net book value or the economic benefits still available for consumption? Has the business invested in new assets? Has the business sold any new assets? So there are many things to consider. So any investor would be curious to scan through the financial statements before deciding if it is reasonable for me to keep investing in this company or to withdraw my money. Okay. So the two non-current assets that we have got are the fixtures and fittings and equipment. So fixtures and fittings, as you know, the cost is given to us in the list at $55,000. The accumulated depreciation when we worked out additional information number 1 is $20,800. How did we get that? So we previously had $15,600, and then for the expense of the current year, we had $5,200, which is included above in the financial performance. And that gave us a net book value, which is the difference between the cost and the accumulated depreciation, to be $34,200. So we have done the same thing for equipment, the cost of $150,000 in the given balances. Then we subtracted the accumulated depreciation of $40,650, and then that gave us a net book value of $109,350. So the total non-current assets and net book value is the sum total for fixtures and fittings and equipment, which is $143,550. Then we show our current assets, and we have to be careful that we have included all of them. So starting with the trade receivables of $32,000, then we subtract the allowance for impairment of trade receivables at the end of the year, which is $640. That gave us $31,360 in the net trade receivables. Then we included the cash and bank of $60,000, which, if you remember, was adjusted for the additional shares that we have raised, additional money that we have raised through issuing shares. Then we have got prepaid office expense of 1,230, prepaid rent expense of 3 months of 3,000, and altogether this gives us total current assets to be 95,590, which when added to the total non-current assets gives us the total assets of 239,140. Okay. What our goal ultimately is to make sure that we have a net amount of 239,140 for the equity and liabilities as well. And this is mainly using the accounting equation, which says that total assets must always be equal to the total of equity and liabilities. So let's see what's going on. So for equity and liabilities, we first start with the equity amount, okay? And that is to include the share capital. Now we have got 125,000 shares. So 125,000 shares are worth $125,000, which is 100,000 plus 25,000 additional shares raised at $1 each. Closing retained earnings of 20,880, which you have just said probably 4 minutes ago, and that gives us total equity of 145,880. Then, as part of our liabilities, we first include the non-current liabilities, because non-current liabilities are part of our financing, because these numbers are relatively huge, which in this case is the bank loan. And the reason this is a non-current liability is because this is not due within the next 12 months, but rather due after the next 12 months, and it is due, in fact, in the year 2028. So bank loan in this case is $60,000, okay? So let me include that. I don't know where the 15,000 came from, but bank loan here is $60,000, which is what you can see in the list, okay? Then we include the current liabilities, starting with the trade payables of 21,000, who are the credit suppliers of the business. Then we include interest payable of 1,500, which is the $1,500 in the expense minus the 1,000 that we have paid. Then we have got wages payable of 2,310, and then fee received in advance of 3,200. Then we have got dividend payable 6,250. The reason this is payable is because we have declared it. We haven't paid it, okay? And when you add all these amounts for current liabilities, you get 33,260. So we're interested in finding out the total equity and liabilities. So what we do is we add the total for current liabilities, 33,260, to the bank loan of 60,000, which is the non-current liability, and then we add the total for equity, which is 145,880. And that should give you 239,140. So maybe I'll just do a quick check. So 145,880 plus 60 is 205,880, and then you add 33, so that's 238,880, and then you add 160, which makes it 239,140. Yep, I'm pretty confident that our math is 100% correct. And that is exactly how you score a perfect 20 out of 20 in this question in paper 2. Okay. All right. So that was a good lesson. I believe you found value in this content. Make sure to drop a like and subscribe to this channel and share it with your friends. And check out the description for links to join my coaching program, which is a 5-month program exclusively designed to train you to achieve amazing results in your exam, and to also make sure you develop an amazing mindset to help you moving forward. With that being said, I'll conclude today's lesson, and I'll see you in the next one.